The human brain is the only thing in the known universe to have named itself. It's evolved over the last 2 million years to keep us alive as a species, and it's done a pretty good job so far. It inherited a drive to reproduce and seek out valuable resources from our common ancestors, and it developed fast decision-making pathways that kept us fed, watered and safe, able to flee danger and literally live to see another day. As we evolved, the complexity of our prefrontal cortex, the human part of the brain, increased. But the fast decision-making framework, with all its inherent behavioural biases, remains largely unchanged. The thinking that kept us alive hundreds of thousands of years ago can be a bit of a hindrance in the modern world, particularly when it comes to money. In this video, I'm sharing the main points from Morgan Housel's highly acclaimed book, The Psychology of Money. In it, he explores the intricate and often underestimated aspects of personal finance and investing. Armed with a deeper understanding of the psychology behind money management and wealth creation, you'll gain valuable insights and practical wisdom to navigate your own financial journeys and hopefully lead you towards better financial behaviours. Right, let's get into it. Human behaviour plays a pivotal role in financial decision making. Emotions, biases, and a herd mentality often drive our financial choices. By understanding these behavioural tendencies, we can make more rational and informed decisions, avoiding common pitfalls and achieving better financial outcomes. The investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham, the intelligent investor. The annual Dalbar study from the US shows us year after year that there's quite a difference between the return of investments compared to the return of investors. The cause of this behaviour gap is always buying high and selling low, trading too often, and not being sufficiently diversified. The New York Times columnist Carl Richards sums it up perfectly with this behaviour gap sketch. We tell ourselves stories to make us feel better. We look for evidence that supports our decisions and ignore or downplay information that doesn't. There's a powerful influence of narratives and stories on our perception of money and investing. We need to separate the facts from the fiction if we want to avoid being swayed by sensationalism. Only by noticing and then critically evaluating the stories we tell ourselves about money can we make more rational financial decisions and avoid falling victim to tall money tales. A key component to financial success is luck. This is contrary to the popular belief that hard work and skill alone determine wealth accumulation. By acknowledging the influence of luck, we can cultivate humility and develop a more realistic perspective on our financial achievements. Time is a powerful ally in the building of wealth. 99% of Warren Buffett's wealth was accumulated after he was age 50. It's all down to percentages and compounding. 5% of £1 million is 50k, but 5% of £1 billion is £50 million. The rule of 72 gives us an estimate of how long it will take us to double our wealth at a given rate of return. Simply divide 72 by the rate of return, say 5%. The answer is the number of years to double your wealth. So 72 divided by 5 is 14.4, so just under 14 and a half years. If the rate of return is 20%, that the time to double your money is just over 3.5 years. Mr. Buffett has just had a lot of time invested. Remember, it's time in the markets, not timing the markets. That's the key determinant of a successful investing experience. Through this compounding of investment growth, even small investments can grow exponentially over time. By starting early and remaining invested for the long term, it's possible to leverage the magic of compounding to create substantial wealth over time. One definition of frugality that I really like is wanting what you already own. Saving money and living within our means are fundamental principles for financial stability. Through conscious spending and focusing on long-term goals, it's possible to cultivate a frugal lifestyle. And by saving diligently, individuals can build a solid foundation for financial well-being and achieve their financial aspirations. Remember that saving is in fact deferred spending. You're not spending it today, so you can spend it at some point in the future. It's also worth reminding ourselves that there's only 3 things you can do with money once you've paid all your bills. Spend it today on having fun, invest it to spend in the future on having fun, or you can give it away to people or causes that you care about. That's it. You can't do anything else with it. Investing inevitably involves risk, but the risk can be understood and managed. Risk and uncertainty impact investment decisions and financial outcomes, but by developing a clear understanding of risk and employing strategies to manage it, we can make informed investment choices and increase our chances of financial success. You see, investment risk, the unexpected and total loss of capital, is very different to volatility, which is a temporary decline in investment values. Investors must receive an investment return for taking an investment risk. Otherwise, why would they bother? The financial system is complex. It's an intricate system with lots of moving parts. Overconfidence, where people overestimate their abilities, like most drivers who think their driving skills are above average, and recency bias, where we think future events will resemble the recent past. The market has gone up for the last couple of years, so it will keep going up, can really hurt us. Humility, continuous learning, and seeking help and advice from trusted sources, like me, are essential behaviours for making better financial decisions and having a successful investing experience. Change is the only constant. Adaptability is essential in the ever-changing financial landscape. Flexibility and open-mindedness are the behaviours for success here. By embracing change and being adaptable, you'll be able to seize opportunities, overcome challenges, and thrive on your way to financial independence. That magical moment when you know that you no longer have to work to provide the income to support your ideal lifestyle. If you work, it's a choice. True wealth is having complete control over how you spend your time, not how you spend your money. Managing expectations is a crucial aspect of financial well-being. Understand what realistic returns look like and avoid the allure of short-term gains. There's no such thing as a free lunch, and if it looks too good to be true, it probably is, are 2 good rules of thumb when it comes to investing. By setting realistic expectations and staying focused on long-term goals, you'll be able to make sound financial decisions and avoid impulsive actions that may hinder your long-term financial success. Beyond accumulating wealth, money should be seen as a tool to achieve a fulfilling life. True financial success lies in using money wisely to create happiness, security, and a sense of well-being. More money won't necessarily make you happier, but as Spike Milligan famously once said, it can give you a better form of misery. This video offers a brief glimpse into the main points discussed in The Psychology of Money, but reading the book in its entirety will provide a more comprehensive understanding of these concepts and ideas and their practical application to your real life financial situation. And as you reflect on your financial goals, let me know in the comments any behaviours you discovered that really help you with your financial decision making. Thanks for watching, and I'll see you in the next video.